But it is interesting, to get more onto the nuts and bolts of how to get these big financings off the ground. What impact has the financial crisis had on demand, and are people now too risk averse? And does, obviously, as I said before, the idea of long-term finance in Africa make people bulk a bit now? Or is it the other way? Have you found that people have started to invest more in Africa away from the more developed markets?
Well, there's certainly been a withdrawal of commercial banks, or there was a withdrawal of commercial banks in finances. Okay. But there have been facilities brought in to replace them. There's this thing called the International Crisis Facility, which was promoted by the IFC and funded up till now only by KfW, which I think is 600 million euros, which is a facility which certain institutions, we and African Development Bank are among them, the ICF will lend dollar for dollar. If you're in a project, you're putting $30 million into a project, they will put $30 million into a very simple credit process. So there has actually been an international reaction to plug the gap, but in the long term, it must be the best solution to all of this is that commercial banks are active in Africa in the same way they are in developed markets.
I think I'd like to comment a little bit about what we've seen in the market, because we tend to lead quite a number of these projects on the commercial banking side in Africa, Standard Chartered Bank. And what we've seen is that it's been more difficult to distribute the deals. So you would typically see a situation whereby at a stage there was no more underwriting capacity available in the market. We were the only bank that was still underwriting transactions. What that brings both opportunity as well as a challenge, in the sense that how do you then lay it off? But what we've seen now is a situation whereby the tenor, which was going like 7 to 10, contracted very narrowly to 3 to 5. So, and of course, for any sensible infrastructure project, you need a longer tenor for that. So what we've seen is a situation whereby we've had to restructure some transactions to fit into that.
But I do think that it's a fact that if you're looking at the pre-financial crisis, the universe of lenders from the private sector certainly shrunk to some sort of a much smaller amount. I mean, if you take an example, say in Egypt, where we did a $250 million refinancing here, just pre the crisis, everyone was at fierce competition, extraordinary terms. And then if you're looking at it now, there's a new project, Dairut, in 1,500 megawatts, maybe you need about $1 billion debt there in Egypt. I think we'll get the debt together in the end, and that project will happen. But I mean, it will be a challenge. You can see World Bank here the other week. I mean, they have Eskom have a World Bank loan, coming into Eskom. Why? Because they couldn't issue those bonds, couldn't access into the market.
By the way, we lent to Eskom before the World Bank, $2.5 billion last year. Same project.
Wow. So total exposure on that project will be $5 billion. That's what
it's actually, the project is huge. I mean, the World Bank loan is $3.6 billion. We lent 2.5, but I think it's more than $10 billion. I mean, it's a very significant.
It's about 10 billion in total.
It just shows the importance of the multilaterals in Africa as it is now. But I think that if you're looking at therefore as an equity investor, the perception of risk is such that you actually can get, as you said, Nick, very attractive risk-reward structures. You can get in there, you can use World Bank's IFCs, the MIGAs, the partial risk guarantee products, and you can actually make good, stable, solid returns in these markets. And look at it, I mean, they have growth. Take your example, a 6% growth in projections, and if you're looking at the financial crisis, a lot of things gone backward, but actually Africa continued up there. So I mean, we're very bullish in Africa. I want to be there and invest there. So.